back here on Wednesday, the 31st of July, the low price this morning was 1,740 pips. I mean, 1,740 pips since that short sell came in from when we started to talk about the scores again, because we told you Forex was massively in focus. Well, I think today might be the last day of it being in focus, assuming equities do balance up today. I've been a buyer of equities this morning, so assuming equities do balance up today, let's see what happens. And obviously, I've been able to buy the pound against the dollar this morning. We had a plus 125 from yesterday, which from Friday, which obviously came from this balance area here. So when it came back into that balance, I bought some pounds, managed to make myself 100 pips out of it, which was pretty good. We went 27s to 28s for 100 pips. So, you know, I'm not against buying risk products, equities, for example. I'm not against that as a storyline. So it's quite an interesting play, but certainly the sell side pound yen with a 280 from yesterday, I don't think we're going to be buying that anytime soon. So it's a case of letting it drop through, and we've ended up with a 1,740 pip profit, even at £10 a pip. A £17,000 profit just since Wednesday last week. Unbelievable. Unbelievable. CAD yen is exactly the same. We touched on that earlier. And we've had some crazy profits on CAD yen as well. So CAD yen was short since the 376 sell side top edge back here on Tuesday the 30th. We started to sell into this on this day here. 211 minus 80. We're still selling it. Minus 461 is just unbelievable. 940 points on the CAD yen. 940 points on the CAD yen. And you've been getting these tweets, obviously, every night, so it's not like it's new stuff. And the interesting thing about the overnight session was we also ran this classroom, if you remember, yeah? Where we highlighted the change in the narrative, where we talked about positive numbers narrative, US dollar plus positive CESI, Fed is lagging inflation, row from negative CESI, S&P positive negative bonds. And you can obviously recognize that these rallies were part of that storyline. But from that storyline, remember we talked about this idea here, that the Fed was waiting too long. Because of weak data. The Fed is still seen as being waiting too long because of weak data. And even on Friday, we talked about this as well. The Fed was waiting too long because of weak data. And what's happened since then? The S&P, since the classroom, the S&P has absolutely tanked through the bottom edges. Do you remember this classroom last week, guys? It's not this week. It was last week. We covered this all last week. So this is a thing we recognize as just normal. It's a normal market reaction to the Fed waiting too long or perceived waiting too long. How do we know that that's a thing? Because bonds go up and equities go down. If bonds go down and equities go up, then of course that's a bounce idea from weak numbers. But if we get equities going down as bonds go up, then that's the Fed waiting too long and we're getting weak data. And now everybody's talking about recessions and a lack of growth, and that's going to be negative oil. So you start seeing that impacting on things like oil and equities at the same time. There isn't just one condition, and I think this is what a lot of retail traders believe when they think about technicals and all that kind of stuff. When they think about relative value, that there is one single condition that dominates the marketplace. There isn't. There's a lot of different conditions. You can get bonds going up with equities going up. You can get bonds going down with equities going down. And then you can have any other of the other combinations. Bonds up, equities down, bonds down, equities up. And it's in the same with oil. When you start seeing equities and oil going in the same direction, it's a growth problem, right? It really is a growth problem. And if it's a growth problem, that can be negative the dollar. So if you see equities going down and you see oil going down, there's a very good chance you might be thinking to yourself, well, the dollar's got to go straight up. No, the dollar might be going down because it's a growth question. It's not anything else. And we see that from the combination of our CESI scores. Well, we know that if we look at the dollar CESI scores, they haven't been good, have they? We covered this also in last week's classrooms, where we talked about the dollar against things like the yen when we've been sell-side the dollar yen, minus 55, minus 205, minus 175, minus 360. The Dixie against the CESI scores. What have the CESI scores been? Minus 33, minus 34, minus 29, minus 25, minus 25, minus 41 from Friday because of the non-farm payrolls. Dollar's going to get tanked on that, isn't it? The dollar did get tanked on it. See what I mean? Dollar Swiss, minus 225, minus 65, minus 240. So in other words, the dollar and equities end up positively correlated in those kind of environments. And therefore, if your model is way too simple and you don't understand the markets, you're going to make horrible decisions. Well, we've tried to teach you many, many times not to make horrible decisions, to get inside that narrative, to get involved in the chatter. If the dollar's sitting on a minus 41 CESI score, we know what that means. It means that the US has been getting dominated by missing data, constantly missing data. And if the Fed hasn't yet moved, what does that mean? The Fed is lagging behind the data. You get it? If you're getting minus data and the Fed is dropping, equities would be pretty bullish. Equities would still be relatively bullish. You'd still have the ability to buy equities on dips and things like that. So what we then have is a narrative that comes from that conversation, which is quite clearly what we've been discussing today in terms of that underlying storyline. And that is that the Fed is currently seen to be waiting too long on weak data. So we need the Fed to start dropping interest rates. I don't think they need to do QE, Paul. I don't think we're at that point. We're still very, 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 very positive in terms of growth at the moment. But I think if the data keeps going, because remember, the first tool in the Fed's arsenal at this stage is what? Dropping interest rates. Well, dropping interest rates isn't QE, is it? It's just an easing cycle, but it's not technically QE. QE is when they start printing some money, right? So when they start adding some liquidity into the economy to bump up a little bit, then we start talking about easing, quantitative easing, rather than simply just dropping interest rates in a normal market cycle. So I don't think we're anywhere near that. I don't think we're anywhere near that as a storyline. So all we do is we treat it as is. That's all we do. We treat what we see. And what we see is that the weak data, which has been dominating the US, well, you don't get a CESI score, guys, of minus 37. The CESI score, look at the CESI scores across all the majors. The UK is on 60. The Canadians are even on 28. Kiwis are on minus 12. The Aussies minus 8. The Euro on minus 25. The US on minus 37. The US number is not good, and it's not been good for a long time. You understand that? It's not been good for a long time. So because of that, we recognize it. Because of that, we recognize the challenges that we're seeing. And we touched on the crash cycle as well when we looked at systemic risk this morning. We talked about zero-day expiries. And we'll certainly go back over those because I think we need to make sure we're all clear about what can happen in terms of market relationships so that we don't make silly mistakes when we're seeing these things. Anyway, welcome in, guys. Welcome in. For what it's worth, there is data, of course, this week. But obviously, nobody will be talking necessarily about the data until we start seeing whether it's going to help us out a little bit. So services PMIs today, and it's not small numbers, is it? We start the week off with services PMI. So I am hopeful that the US does actually, for the sake of everybody's equity pensions, I'm hopeful that the US puts in a reasonable ISM services PMI for a change. Because for a change, a good ISM services PMI could actually be bullish for equities because people will see, well, wait a second, the numbers aren't as bad as we maybe thought. And that would obviously improve the CESI score if they did come in positive, and we might get a little bit of a bounce out of that. Now, there's also a double-edged sword if they come in really bad. If they come in really bad, and I'm talking about a big miss back below the 50, then there might also be an equity bounce because what will happen is equities will tank first of all. You'll get a big sell-off on a bad data release, And then everybody will be saying, that's probably got to be it, right? That's got to be it. That's going to be the final number that the Fed needs to start thinking about even 50 basis points. You agree? You think that would be a case, Michael, Jack, Paul? They might even contemplate 50 basis points at the next meeting. Now, you might say the Fed will never do 50 basis points, but yeah, you might be right. It would be very, very, very unusual. But if the market is crashing, if the market's crashing and it doesn't have any signs of any improvement, and I'm telling you, 50 basis points is not off the table. And I'll show you why it's not off the table. Did you know that this was happening this morning? We've actually touched the 500 basis points on the next Fed move. The current move could be 50 basis points now, couldn't it? See it? So there is a very high possibility that this is real, that you could actually look at that and say there's no reason why the Fed... So in other words, what I'm saying is, if there is a sense of depression creeping into today's ISM services, on its own, it doesn't seem as if it's one of the most important releases. But because of what's currently happening, I think it's a really important release. And because of that, what we would then see is if it comes in as a horrible number, and I'm talking about a horrible number below 50, then there's a very good chance that we'll get a big smashing drop on equities, but that's going to be a buy-side bounce. Because that's going to put the Fed into mode of, let's get this rate cut out. And there could be an emergency shout on that one. Because if that drops below this level, guys, that's almost arbing in a trade at a 50 basis point cut. So if you've been watching the Fed basis numbers today, you'll know that that trades down to the 500, which means that the next Fed move could be 50 basis points. Almost unheard of, not unheard of, but almost unheard of. And we did talk about this inflationary drop just last week, didn't we? We said that the Fed is running way behind the curve now. If this inflation drop here stays in place, and it looks as if it's staying in place with oil prices down at the 70s. Now, oil prices aren't cheap. I mean, it wasn't that long ago we were trading oil at $60 a barrel, right? And obviously, we also have that small matter of the Middle East still bubbling away in the background. So, there's a few things we have to just take into consideration. And I'm not claiming for 1 second that this is an easy market, guys. The one thing we don't do with this market is we do not cycle markets like this. Do you understand that? We don't try and cycle these markets. We try and trade these for pops. This is high volatility trading. The one thing you never do in high volatility trading is try and cycle it. You get it? You trade it for pops. So in other words, if I find buyers trapped at low prices, I'll be a seller. If I find sellers trading at high prices, I'll be a buyer. I'm trading for volatility extension trades. I'm not trying to cycle these types of markets. I'll cycle it every now and then, but I'm not, as default, my normal mode of operation is to be cycling markets. As a normal mode of operation, I am counter cycling. I am going for the volatility press. Stay with it. Stick with the deal. Try and buy or sell your pullbacks, right? Try and stay as much as possible focused on the directionality, and don't be the guy that tries to call the bottom edge on every moving market. You will lose a lot of money. You might make some money, but I can almost guarantee that unless you're pristine on your entry process, you will probably lose money trying to do it. So we got short the S&P. I bought the S&P earlier. I managed to get some short. We actually called it live in the room. We showed a level for people to get short from on the NASDAQ. And this is what we've been trading this morning. And if anybody decided to join me, there was a bit of buy-side liquidity we managed to sell into just here at 820s. It's now traded down here at 17,400. So in essence, about an $8,000 per contract short. We were buy-side this morning. It's called the art trade, and we talked about why that was a buy trade, why we were able to make a safe bet on this buy trade, you'll see it's not buying the bottom tick price, right? It's not buying the bottom tick price. We'll discuss why I was able to safely buy into this leg higher. But we did talk about it. We said about the buyers getting a little bit long, and obviously we've decided to rejoin the short sell at 850s, and that's worked out beautifully. We're back towards the bottom edge, and I don't think I'm going to be holding it below the bottom edge, but again, I'm waiting for this storyline. It's not the same as it was. It's an acceptance of lower prices, so I am not getting long at this stage. I am not getting long at this stage. There is macro value divergence. There is micro value divergence, but there is also lower price acceptance. So with that lower price acceptance, I wish I'd now sold this one. That would have been a better sell, wouldn't it? What I did at this price, by the way, was just close my long positions. I never got short, with all honesty. So the sell trade came in for me here. But I am now exiting that position, and I'll be happy to take a break and let the pre-market give me some pointers to what's going to happen next with this absolute shit show. Everybody happy with that as a storyline at this stage? But we'll be talking about this. We'll be talking about systemic risk from last week. We'll be talking about volatility zeros as well, so that you can understand how you would have known about this. We have put out a few care warnings going back to July, so we have been telling you about some risks that were developing in the background to this market. As you know, we've already been kind of on top of some of the risk elements on this. But when you see some of the roles that you've seen developing, you're obviously very, very aware that those roles have been, as a rule, pretty bearish overall, right? Pretty bearish overall. Anyway, I'm going to grab some lunch, and then we'll get started. But just be careful, guys. If you see anything getting trapped, because today is all about extensions of volatility, as soon as you see anything getting trapped, you know you don't want to be on that side. So if you're on that side, get the hell off it. Don't hang about for confirmation. The confirmation is a big hell of a big stop loss with slippy volumes. So you're going to get smashed in the face several times. If you're getting trapped and you know you're getting trapped and you don't come off that trade, then hell mend you guys, you're going to get absolutely mauled, right? Because you can see that happen to the gold traders in here. Look at them. This was a buy trade in here. There was opportunities to buy this with some value. But as soon as you see the buyers getting trapped and then trapped and then trapped some more and then trapped some more at lower prices, that is one hell of a big Charlie D reversal, right? At lower prices, get in for the press. My God, get in for the press. When it settles down, back to normal. Until it settles down, volatility extension trades predominantly dominating your thoughts. And that's been the case since last week. When you have a higher volatility environment, you shouldn't be trying to effectively call bottoms or tops. Although today we called the bottom edge of the NASDAQ quite nicely, actually. But we'll go into why we were able to do that so that you can see the difference between a good bottom edge and a bad bottom edge. Anyway, lunchtime. I'll be back shortly.